10 financial moves you will never regret. Net Maverick Edition. Getting wealthy and scaling your finances isn't actually about complex mathematical formulas, despite what most people think. If you look back at the last 50 years of financial history, the individuals who left a real mark on the economy always stuck to the same simple yet unbreakable rules. Money has a funny way of working. It rewards the right decisions over and over again. Today, we're cutting through the noise of flashy financial trends. We are diving into 10 golden moves that have survived recessions, inflation, and all kinds of economic bubbles. Moves you will absolutely never regret making. Welcome to Net Maverick. 1. Secure equity. Company ownership/shares. Whenever possible. If you look closely at the moments when everyday people suddenly experience life-changing wealth, you'll find a single reality behind all of them. Equity events. Whether it's a company going public, getting acquired, a buyout, or even inheriting a family business, this is where real wealth lives. When giants like Microsoft, Apple, Nvidia, Amazon, and Google grew into trillion-dollar behemoths, thousands of early employees became millionaires. Why? Because their compensation wasn't tied to a salary alone. It was tied to ownership. Ordinary people negotiate for a higher salary, while the wealthy negotiate for equity and a seat at the table. If you are bringing serious value to a project or a business, always ask if there's a path toward partnership. This single move can outweigh decades of standard raises and corporate promotions. 2. Build a cash emergency fund, even if you don't think you need it. In America, the average unexpected emergency expense easily crosses $1,000. For most households, the arrival of just one single bill means spiraling into credit card debt, delaying bills, or taking out a high-interest loan. Cash gets a bad reputation these days. Every time interest rates drop, someone out there claims cash is trash. When the stock market is booming, sitting on cash feels lazy because it doesn't grow at the breakneck speed of stocks or real estate. But that is completely missing the true purpose of cash. Cash isn't meant to make you rich. Its job is to keep you from going broke. People who need money the most are usually forced to liquidate their assets at the worst possible moment, when prices are hitting rock bottom. People with a solid cash cushion don't face that problem. During a crash, instead of panic selling their investments, they leave them alone to compound. Instead of putting a surprise expense on a 20% interest credit card, they pay cash and move on. Sometimes, while everyone else is selling out of fear, they become the buyers. 3. Walk away early from dead-end jobs with low-growth ceilings. Every single industry has a ceiling, a maximum limit to what you can achieve. Before you commit years to building a career, check where that industry's ceiling actually is. Ask yourself 2 simple questions. Is this field creating more opportunities than it did 5 years ago? And are the people 10 years ahead of me living the kind of life I actually want? If the answer to both is no, it's time to move on. Every profession fundamentally has 3 ceilings. The income ceiling, how much the top performers earn. The demand ceiling, is demand for this skill growing or shrinking? And the ownership ceiling, can you eventually own a piece of it, like a business share or partnership? Or are you just trading hours for dollars forever? Before you spend 10 years trying to master a job, spend 10 hours figuring out if the job is even worth mastering. 4. Dodge the trap of lifestyle inflation. Be honest, what's more exciting than a brand new BMW? Nothing at first, but every single lifestyle upgrade comes with an expiration date. Every shiny new thing in your life will become ordinary much faster than you expect, and there's almost nothing you can do to stop it. Psychologists call this hedonic adaptation. Essentially, it means humans naturally drift back to their baseline level of happiness after both positive and negative life events. In the real world, it looks like this. You could move into a luxury penthouse and drive the latest sports car today, but that thrill will wear off in about 6 months. Once it becomes normal, you'll just start looking for the next upgrade. Keep in mind that today's luxury quickly becomes tomorrow's basic requirement. 5. Boost your savings rate before over-focusing on investment returns. The financial world has conditioned people to view saving as trivial, turning investing into the ultimate answer to every financial problem. But the reality for most people works completely the opposite way. Imagine your goal is to add an extra $10,000 to your net worth this year. There are two ways to get there. The first is through investing. Assuming a solid 7% annual return, you would already need roughly $143,000 fully invested to make an extra 10 grand before taxes. Most people simply don't have that kind of capital sitting around. The second option is to increase how much money you keep. Your savings. This means postponing an expensive vacation, driving your current car for another 2 years, cooking more at home, canceling unused subscriptions, or simply saying no to a few impulse purchases that look exciting today but will be forgotten in 6 months. Don't label this as a poor mentality. The wealthiest people on earth spend an incredible amount of time figuring out how to keep more of the money they already have. Holding companies, tax attorneys, family offices, these aren't just money-making machines. They are money-retaining machines. 6. Never use debt to buy depreciating assets. The faster an item loses its value, the less willing you should be to borrow money to buy it. Of course, this doesn't mean you should never finance a depreciating asset. Sometimes you legitimately need a car to get around. The key is understanding the balance. If you are taking out loans for things that drop in value every single year, make sure the utility you get from it heavily outweighs the money you're losing. An essential work vehicle that helps you secure your livelihood is light years apart from a luxury SUV bought purely to impress the neighbors. Paying extra interest just to own something that loses value day by day is a losing game. 7. Increase your income every single year. If your income stays flat for more than a couple of years, your standard of living is actually sliding backward due to inflation. Most people just cross their fingers and hope their boss will fix the problem with a yearly raise. Sometimes that works, but usually it doesn't. Studies show that employees who change companies more frequently end up with significantly larger salary bumps than those who stay loyal to the same firm for years. Loyalty is a great trait, but markets don't pay for habits. They pay for results. This doesn't mean you should quit your job tomorrow. It means income should stop being a passive expectation and become an active project you work on. Learning a highly specialized skill boosts your earning power. Negotiating your salary sets a permanently higher baseline. Building a side hustle creates a revenue stream that isn't dependent on a single company. How you do it doesn't matter as long as it's legal. But every year, ask yourself one simple question. How can I make this year's income outpace the last? 8. Negotiate every single major purchase to lower the price. Plenty of people speak up to negotiate a higher salary, but very few speak up to negotiate what they spend. It's a strange double standard because, financially speaking, the outcome is identical. If you secure a $10,000 raise, you brought in more money. If you negotiate $10,000 off the price of a house, you saved the exact same amount, except the latter lands straight in your pocket, completely tax-free. For some reason, we've accepted the idea that prices are written in stone. At the grocery store, sure, they are. But step onto a car lot, walk into a furniture showroom, or enter a real estate deal, and those prices become highly flexible. Those are the environments where thousands of dollars shift hands every day. The next time you're about to make a major purchase that you'll still remember 5 years from now, don't just say yes immediately. Pause. Ask for a better price. Demand better payment terms. Find out if there are any available discounts. The absolute worst answer you can get is a no. The best answer could save you more than your next raise. 9. Buy assets that pay you simply for holding them. Not all assets are created equal. Some assets appreciate in value over time, while others appreciate and pay you a steady stream of cash just for owning them. This subtle difference has generated an unbelievable amount of wealth worldwide. Think about a bar of gold. If the price of gold goes up, you make money. The same applies to a rare timepiece, a collectible car, a piece of art, or even your primary residence. These assets can gain value, and one day you might convince someone to pay more than what you originally spent. Now compare that to an income-producing asset. A rental property sends you a rent check every single month. A dividend-paying stock shares a portion of the company's profits directly with you. Data shows the wealthiest families keep the vast majority of their fortune in businesses and stocks. The richest 1% own over half of all corporate equities in the U.S. These assets produce cash while growing in value, and that cash can be reinvested to buy the next asset. The asset starts helping you buy the next one. This is how true wealth compounds. 10. Know exactly which pocket you are spending from. Before making any large purchase, ask yourself this core question. Am I paying for this with my income, my investment returns, or my principal? Income is the money you grind and work for. Investment returns are the yields your assets generate for you. Principal is the core asset itself. Imagine you want to buy a boat. Maybe this year's bonus covers it, income. Maybe the rent checks from your real estate portfolio pay for it, returns. Or maybe you have to liquidate a portion of your stock portfolio to afford it, principal. The exact same boat, but 3 completely different financial decisions. This is why many wealthy families live by a straightforward rule. Spend the returns, protect the principal. A portfolio has one single job: to continuously produce money. This doesn't mean you should never liquidate an investment. Sometimes selling assets to travel the world or buy your dream home is the right move. Just be completely honest with yourself about what you are doing. Financially, you are shrinking your portfolio to expand your lifestyle. They are not the same thing. You just need to know exactly which trade-off you are making.